Every quarter, Wall Street throws itself a party. You weren't invited. You were just asked to believe the results. That's not cynicism. That's accounting. You think you know what earnings season looks like. You think it's companies reporting their numbers, analysts weighing in, markets responding honestly to real performance. It sounds rational. It sounds transparent. It sounds exactly like a system that has nothing to hide. It is a performance in almost every detail. There are three completely different things people collapse into one: a company's actual financial performance, what it earned, what it spent, what it owes. A company's reported financial performance, the version it chose to show you, after adjustments. And then there is the expectation game, the quiet machinery that runs underneath both of them, deciding in advance what good is going to look like this quarter. That is what nobody explains to you. Here is how it works. Analysts publish earnings estimates. Wall Street treats those estimates as an independent verdict, an objective measure the company must meet. But those analysts spend their days on calls with the very executives whose companies they're rating. The information flows one direction. Companies guide analysts toward a number, not the real number, a lower number, low enough to beat, high enough to look credible. Then the quarter ends. The company beats. Stocks surge. Headlines celebrate. CEOs collect bonuses. Nobody beat anything real. The second layer runs deeper. When those earnings finally arrive, they arrive in two versions. GAAP, earnings, the official accounting standard that includes the ugly costs, and non-GAAP, earnings, the adjusted version, where companies surgically remove whatever makes the number look bad. Restructuring charges, gone. Stock compensation, gone. Acquisition costs, gone. What remains is called profit. The removed parts were also real money. Real money that disappeared. You can report a loss and a profit in the same quarter. Dozens of major American companies do it every single year. The financial press covers both numbers, never quite explains which one is true. Moves on by Friday. Then come the consequences that never trend on Financial X. To hit an earnings target, companies cut costs. Costs have names. The names are on payroll. Hiring freezes come first. Layoffs follow. Wages stay flat while productivity metrics quietly rise. The stock goes up. The workforce goes sideways. This is called a beat. Executives with stock-based compensation cash out on the surge. Institutional investors who read the guidance correctly positioned weeks ago. The financial media writes the headline it was always going to write, and the ordinary American, watching the number flash green on the screen, walks away thinking the economy must be doing well. It might be. It might not be. The earnings report will not tell you which. Don't just watch the stock price and call it research. There is a number that actually measures economic health. It is not quarterly earnings per share. It is not adjusted EBITDA. It is whether the people who do the work are earning more, spending more, and carrying less debt than they were 12 months ago. That number is harder to spin. The game is already running. The only question left is whether you understand who designed the scoreboard before you mistake it for the score.